Post-Liberation Day, we'll be looking at these severe Trump tariffs, which were announced last night, and discuss exactly what this means for markets, and of course, whether you indeed feel somewhat liberated. So let's get straight into it then. Okay, so hello and very, very warm welcome to our latest urgent market update video for Thursday, the 3rd of April, of course, 2025. Now, the title of this short video is we are now the day after the night before, so post-Liberation Day. And there was a lot of debate going into this particular event as to whether Donald Trump would actually water down some of the tariffs and become a little bit more targeted and not be such a very significant problem for financial markets, and more important than that, the impact that it will have on the global economy, because there's a bit of rebalancing in play now. So we're going to look at the tariffs, and we're going to discuss potentially what this means, and we'll leave you with some of the opportunities that could be exploited. So let's get straight into it then. We'll, of course, start with our risk warning. Take a brief moment to familiarize yourself with our risk warning currently up on screen. As always, be mindful of the risks involved in trading these financial markets. Okay, so let's get straight into it then. So we'll start with just a little bit of an update on the actual news event itself. So last night at 9 p.m., Donald Trump made his way onto the Rose Garden in the White House and was able to discuss the plans that the U.S. administration have around tariffs. Now, there's pros and cons to the principles of tariffs. What we were debating, certainly last night, we were broadcasting this event live and seeing where we were likely to get the best opportunities. And we were left with two potential outcomes. The first one is, will Donald Trump drive home quite a severe tariff announcement, which is quite broad, which is quite, in terms of tariff rates, significantly higher, and who would it include? Now, he obviously, that option was available to him, and he's made references to that, to this being exactly what he was planning to do throughout. And then he'll throw a couple of sort of comments around, which would just make you double guess yourself and perhaps say, well, he may just look to water these things down because he knows the potential fallout could be quite significant. And therein lies the other side of the argument, where if he waters them down, then we could probably get a bit of a positive market rally. But what we saw clearly was a severe reciprocal tariff announcement, going after, sort of looking to rebalance the world economy to a large degree, and to start removing some of the unfairness which Donald Trump himself and his administration thinks is currently in play. I mean, most people would look at the US economy and think they've done phenomenally well over the last 40 years. He looks at the economy and says they've been absolutely decimated. So you've got to marry up these two things. So there's a lot of, on Forex Factory, of course, there's a lot of information you can do, a lot of reading around the topic. There's lots of articles as well. The question is, he's referring to it as Liberation Day. How liberated will US consumers be? US consumers are responsible for 70% of GDP in the US. A lot of imports into the US brought prices down, were quite disinflationary, and it obviously gives a whole range of choice to the consumer as well. And now Donald Trump is going some way to basically shift that basic principle. He's making those imported goods and services more expensive, trying to obviously stimulate the domestic economy, to make buyers choose, US made goods and bring manufacturing back to the US. All of that are very sort of noble reasons. The reality of it is that does have a direct implication regarding inflation and the fact that US consumers will now start paying higher prices. And because this is reciprocal, this is, we ourselves, every one of us are very likely to pay significantly higher prices in the not too distant future once corporates and governments learn how to sort of navigate around this. Now, there's one caveat that needs to be stressed in all of this, is that if Donald Trump reverses these tariff calls, which he's now implementing, like in a week's time, if there's lots of negotiations with a lot of these within these areas and with all these governments, because they are sort of average tariffs, they're not very specific and they're not that targeted. And then there's some additional targeting as well around steel and aluminium and autos and a few other areas. So the difficulty starts to kick in is if the US administration starts to unwind some of these tariffs. And some of that we're looking at when these things will go into place. He's imposing minimum 10% tariffs globally. It will take effect on the 5th of April, with higher tariffs taking effect on the 9th of April. And as we're recording this video, it's now the 3rd of April. So there's 2 more days before we get the 10% baseline tariffs installed. Then, as I'll bring up a little chart just now. So look, there's more information there in Forex Factory if you want to spend a little bit more time, of course, looking into this very important, very significant shift for financial markets. And the reason for that shift is what you can pretty much see currently up on screen. Is it's a reciprocal tariff. So what Donald Trump spent a bit of time discussing yesterday was exactly the tariffs that these other countries put on US imports into their country. And he believes that this is an unfair disadvantage that he's now trying to correct. So what he's doing is he refers to it as tariff light. So it's not full reciprocal tariff, because that would mean, putting a 67% tariff on Chinese goods. So what he announced yesterday was pretty much half of what these other countries are charging the US. Now, we don't really need to go down a rabbit hole in terms of the reasons for this, because these are the decisions that the US administration have now made. So this is the reality that we're effectively having to deal with. So you can see the European Union there. The European Union charge, according to the Trump administration, an average of 39% tariff on US imported goods into the Eurozone. So he's now in turn imposing that 20% tariff on European goods into the US. So what we want to do is, we can all agree that this is a very severe approach to tariffs, and we've been in this, or should I say, the US economy has been in this position before. And before I explain the consequences, I want to just share the fact that we've been in this position before with the US administration trying to impose a blanket tariff ban. Now, it's called the Smoot-Hawley Tariff Act, and this was enacted in early 1930. And if you know your history, there was a global stock market crash at the end of 2029, which was a contributing factor, a very significant factor, with the Great Depression in the US, which you could argue lasted the best part of perhaps 20 to 30 years before we saw asset prices start to make new highs. So what that led to is very significant unemployment. And one of the contributing factors to the Great Depression was what the US administration were trying to force through, which was increasing tariffs once more, like it did prior to income tax. And it was largely, you can see here, that this act, in hindsight, is now widely blamed for worsening the severity of the Great Depression in the US and around the world. So we don't want to be alarmist, because something to the extent of, at the point of this particular act, Tariff Act, which was kind of a broad 20% tariff across imported goods into the US, at a point where imported goods sort of represented between 2 and 3% roughly in terms of US GDP. So not particularly reliant on that as an important feature for the US economy, versus nowadays, which is, from what we understand, is between sort of 13 and 14% of US GDP is driven by US imports into the country. So we're at a very, very different stage for so many reasons. So we're not suggesting we're going to get a Great Depression, but what we are suggesting is that this is not ultimately that good for the US economy, despite what Donald Trump will put forward. And we've got precedent. We've been here before. And I mean, there's a lot of other sort of social related issues and stuff, and significantly high unemployment. And you can read up on this Smoot-Hawley Tariff Act. But let me show you what happened from a price action perspective when this kicked in. And you can have a look at this chart here, and I'll zoom in on this little space. But look what happened. If we just take the highs around the 580, this is $580. This is the S&P 500. Two things. Firstly, by the time we got to 580 again, was towards the end of the 1950s. So we're talking about 30 years before we saw a full recovery. So that's a lifetime, that's a generation. So significant potential impact. And look where we are now. We're up at 6,100, and we're now obviously rolling off the highs. But it's this little period of time in here that I kind of want to draw your attention to. And let's have a look at this in a little bit more detail. So what we saw towards the end of October 1929, we were in a bit of a, we had the booming 20s in the US, and a very significant rally in asset prices over the course of that period. And you had mass adoption. There was, retail investing was at record highs, and there was a lot of people's wealth being pumped into these equity markets. So obviously we had a market crash, 29th of October, 2029. There was a bit of weakness going into it, but you could see the fall off. So we peaked pretty much at, let's say 580. And then over the course of the next month and a half to 2 months, we were down at $400. So as a result of that crash, we saw a significant panic, and somewhere to the tune of, let's say 600 to 400. So let's say we lost to 30, we had a 30% reduction in asset prices from in the S&P 500 as a result of that stock market crash. The banks freezed up, they couldn't refinance, there was no lending. So it literally created a bit of a depression in the US economy. But then look what happened. So we go into 1930s, January and February, and during this little period, we kind of recovered a little bit. There was a little bit of a strong bounce. And this was the time when this act started to be enacted and came into force, the Smoot-Hawley Act. And then look what happened. So you had the problems with the banks, you had mass unemployment, and you had social deprivation, and families all around the US really, really struggling. Some parts were struggling far more so than others. But look what happened. We went from 460 right the way down to the lows in June 1932. So we spent the next 2 years, 2.5 years, where we were down at pretty much $100. So we rallied from the highs of $600 down to the low of $100. So that's an 80% collapse in asset prices, and this is only just looking at the S&P 500. Let me show you the Dow Jones. So it's not just, it was across the board. We had that rally in the 20s. We peaked, let's say, at 380. We had that massive stock market sell-off for a couple of months. We had a strong bounce, and then the Smoot-Hawley Act kicked in, and we saw these come back to sort of $50. So an even bigger move in markets like the Dow Jones Industrial Average, and again taking 30 years before we break these particular highs as well. So this has been a significant feature. So a lot needed to change around these lows with sort of government policies and stuff, and we started to see a little bit of a bounce. We went through World War II, went through a bit of an up and down phase, as you can see, and as we started to come out into the 50s and then into the 60s, we started to see these asset prices come out of this whole sort of depressive sort of phase and start to build asset prices. But you're talking about a 30-year depression. So we do have precedent for what's happened previously in the past. We fully understand it's in a very, very different context, so it's not ultimately that relevant. But even if you can go as far back as the dot-com bubble, you'll see that these markets can be prone to really significant corrective moves. And this is the dot-com bubble. Again, really, really strong rally going into the late 90s. And then you top out, we had a massive market crash. There's your initial crash, and there's your bounce. And then, you're looking at another leg, massive legs to the downside, where you've gone from over $600 to below $200. So again, you're seeing a 66-70% collapse in asset prices, and again, can often take quite a long time to start. Basically another generation before that these things will start to make new highs, which we've done so recently in the last sort of 6 or 7 years. So this is the backdrop, and this is really the point we want to make, is that if we compare and contrast that to what's going on in markets like the S&P 500, and let's look at this on the daily time frame to begin with. What did we see in the last, well, you probably have to go back probably close to 15 years, where we've seen nothing but an exponential rally. If we look at it we've had periods of pockets of difficulty, but you're talking about the lows of 2009. We've been in a very, very significant rally. We had COVID in there, and then we had the Fed cutting rates in 2022, which saw significant weakness. But apart from that, it's been pretty bullish. So this is where we've got, okay, in the last month or so, we've seen some significant selling, and our expectation is that we're going to get further considerable selling to the downside. So this isn't a short-term view. So let's look at it on the daily then. There is your turnaround. We were surprised to get such a bullish response yesterday for most of the trading day. Really surprised about that before the actual sell trade started to kick in. Now we're positioning ourselves to the downside in these markets, and we're going to continue to do so for the not too distant future. And anytime we get a little bit of buying in these markets, we'll be looking to see if we can capitalize on a bit of a sell trade. And this morning for our traders live, we were able to get into these trades, and with the expectation that we will continue to get further moves to the downside. So, but the point we want to make is we're not suggesting that we're going to enter some sort of depression and it's going to be game over. But what we are suggesting is we've seen what's happened when the US government tried to impose these. And again, the government back in the 1930s, we're expecting that to be a positive impact and to try and, fire up the domestic economy to the point where we get out of the stock market crash. And you can see it just contributed, and things got so much worse. So we're not necessarily buying into the positivity that Donald Trump himself is very vocal about. We're actually looking to position ourselves on a fairly consistent basis to the downside, not just for the indices. So our expectation is that over the course of the day, we For Mag 7 as well, they're very likely to experience a very, very weak trading day ahead. Further momentum from last night. All of this kicked in the last hour of last night's markets. We were really quite bullish up until that point, and you can see what happened in a very, very short period of time. Mass selling, further gap to the downside. All we've done really overnight is kind of pulled back, but our expectation is that we're going to be making new lows in the not too distant future. Now, could it bounce back and could we start selling at higher prices? Yes, that option's all available. But in terms of being genuine buyers in these markets, under the current circumstances, we would suggest we're certainly positioning ourselves to the downside, and that we'll be looking to get into those trades as often as we possibly can. Now, the one caveat we will leave you with is that if the US administration and Donald Trump row back on these tariffs, that could potentially lean into a bit of a game changer for the US economy in a more positive dynamic, because we do get these, we will be getting, in fact, a lot of the reason for a lot of this additional charges, which means more money into the US Treasury Department, would make room for some tax cuts. Now, the interesting sort of aspect to that is, will that be tax cuts for already very, very wealthy people? We fear that it probably will. Now, let's see how this plays out. But if he rows back on these tariff commitments, which he very well may do, and he brings out, so you'll get a little bit of a market bounce off the back of that, and then we get all the potential tax cuts, and we get a better deal for the US. All of a sudden, you'd have to build in the uniqueness of the US economy, driven by artificial intelligence and intelligence, and that whole narrative could really create, as long as the hard data remains relatively positive, which it is for now, but that may change. So there is a caveat very much in place that this is short-term weakness, and potentially for as long as these tariffs are in play, as he discussed last night, then we'd probably only think that this is kind of bad news for equity prices. Now, what does it mean for the dollar? Well, let's show that to you right now. It means exceptional upside and in the euro dollar, and weakness in the US dollar. And you can see that play out across the board in a very, very aggressive dynamic. Dollar yen, the pound dollar rallying to the upside, dollar yen to the downside, dollar Swiss, massive moves in these markets, trying to devalue this US dollar against the CAD, against the Aussie, against New Zealand. So that's the other trade to look out for. And, this is going to be probably a series of opportunities to try and take advantage of. So do bear that in mind. We absolutely have our positioning. We do understand that if the circumstances change, we can very easily kind of change our views. But for now, because we're day traders and we look for swing-based opportunities, that very much means that we will be flexible enough to capitalize on some further momentum lower, and also be able to, if the circumstances change, we can then change our own opinion. That's an important feature of our approach. Okay, so look, we've covered a lot of data in this video. Didn't plan on it going on quite this long, but there is a few things to explain. So hopefully that gives you a little bit of a better understanding. And it's about the implementation of these tariffs and what that means for financial markets, which is really the only aspect of really what we need to know, is what expectation do we have. And as you know, that's further weakness in the indices and further dollar weakness from the currency markets. Okay, so listen, on that note, we'll wrap it up there if that's okay. Any questions, feel free to email us at support@thelivetrading.com. We'll get back to you as soon as we can. If you do have any kind of burning questions about what's covered in this slightly longer than expected video. So on that note, guys, listen, thanks very much for joining us. Do stay tuned for our next video. And yeah, we look forward to seeing you next time. So from everyone here, take care of yourselves, and let's see how these markets play out. We'll speak to you soon. Bye for now.